we had the Brexit situation. The market had a rather large break and has recovered basically the entire move, actually, and then some. The Brexit turned out, in my view, really, I don't really think that it's as big a deal for the U.S. as people seem to think. We don't do all that much business with Europe anyway, as far as what we export. We do happen to have we do happen to do well with the UK, but in general, it's not really a. We don't do that much business, and the amount that would be damaged by it is rather low. Everyone always seems to think that the Brexit is going to be so bad for the UK. I actually think it might be good as their currency comes down. I think that their real estate market is going to get quite a boom as far as buying properties in London, people going on vacation there. Yeah, I get that there's some uncertainty and businesses might be a little reluctant to invest there, but I just don't think it's going to be as big as everyone is so afraid of. With regard to the markets, so let's go through some of the stuff you guys want to talk about. Let's start out with SPY. Keep it simple. So today we had a bit of a liquidation break off of the open. I'm sorry, not off the open. We did have a rally higher, and then we had a liquidation break. We had a bit of a poor high today. It wasn't overly poor, but a little bit. And it doesn't surprise me where it came from. I've been talking about SPY 210 to 211 is sort of the must close over. The bulls need to really take price through there with some authority. And that is still winding up as being a little bit of resistance. So I guess we stalled a little bit at the upper end of the range. Not really that big of a deal. We had an attempt at a pullback the last couple of days. Yesterday was a second test of the 50 MA, and I guess a look below and fail. If you look at the body of the SPY bar, it was roughly in line with the prior day's low, and the body itself was above the 50 MA. So it seems to me that the market isn't so keen on the idea of going down so quickly. You can see that today's low roughly tested the lower end of the support range, and it held. The range I talk about is the remember I in my videos I talk about the wimpy head and shoulders. Yeah, so anything that in my view is above the 208.54, which was the failed right shoulder, I view as being bullish, and anything above 208.97 keeps all-time highs in play. That is the key level, that little range. As long as you're above there, all-time highs are in play. If you get below there, it starts getting a little bit more iffy. Today was really just a pause. We wound up closing up near the higher end of the day's range. And it really, for the most part of the day, other than the kind of later day liquidation, further break, and then rally back up, was really more of a consolidation at yesterday's high. So prices accepting still higher. With regard to where I think SPY is going from here, so tomorrow we have an unemployment number situation. I don't really necessarily know how great or bad the number is going to be. I honestly don't have much of an opinion on it. I don't necessarily think that the read is going to matter. I believe the Fed is going to be on hold for a while, given the fact that we had the Brexit. It seems to me that the data going into the Brexit was weakening. The data now isn't phenomenal. I will say this, though. We did have a number, one economic number that I thought was a little bit more encouraging. The ISM service number was a pretty solid beat. The numbers have been awful going before that, so maybe this is just a kind of a bounce and a downtrend. I wouldn't hang my hat on one read anyway, but it seems to me as though that might be doing a little bit better. I know the ADP unemployment number today, I think I have to check, was maybe a little bit better than they had expected, but it's really, I guess it really matters on where your expectations are set from. They kind of were low going in, so it's sort of like not such a big deal if it did better. I mean, it's just like If you go in kind of expecting it to be crap and it's crap, or maybe it's a little like crap light, it's sort of like, all right, whatever. So I really don't necessarily think it's game on here with the Fed. Like we're going to have to start worrying about rate hikes again. GDP has not been good, and the world we know is slowing. So it seems to me the Fed would have to be very foolish to want to hike rates. The dollar has been strengthening. They don't want that. You have other countries racing to debase, and it would be a huge mistake in my view for the Fed to be back on the table. That being said, if we get a hot employment number tomorrow, that doesn't necessarily mean that the futures can't get kicked around. So we have to be a little bit cautious with that. So I'm going to keep it really, really simple for tomorrow's trade. If we can get back up above today's high of day tomorrow, then I think we're going to rally back up to the 212s area. If we were to get back below today's low of day, then I think we will retest the 50 and could potentially test lower. So I'll tell you this much: what I view the Brexit as is that we rallied into it, and people got a little overly excited. They thought it was a sort of a fait accompli that there would be no Brexit, and they ramped we had a rich close. I had been expecting that next day, Friday, if there was a Brexit. Regardless, I thought we were going to come back down to the 210 area and pin there. You wound up getting the surprise of the Brexit, and you had what would have been a kind of more controlled liquidation break that got really steep. And I'll tell you, in my experience, sometimes markets, I forget who says this, maybe Dalton. He says sometimes a market needs to break before it can rally, and then sometimes it needs to rally before it can break. And that's James Dalton, by the way, not Dalton from Roadhouse, although I often like quoting him as well. Expect the unexpected. So that's really what happened here. You had very poor structure coming down, you had poor structure coming up, and I said that you can have bad behavior kind of canceling itself out. So I don't necessarily know that I think you could kind of just sort of glance past that poor structure for the move down and the move up, since they kind of counterbalance each other. And it was sort of for the length of a cigarette, right? Like if you were away, if you went to use the bathroom or went to smoke, you missed the Brexit crash, right? I mean, what Brexit crash? We were back pinning 210 basically last Friday. I think it was in after hours it wound up pinning it exactly. So that's my view here. As long as we're above 208.54 to 208.97, you have to think all-time highs are in play. If you get below there, things get a little bit more iffy. I would say since the 50-day has now held twice in the last bar, that's sort of your level to shoot against. If you lose it, it starts getting still more bearish. I'm sort of in a little bit more optimistic camp with that regard. I will say this is a big caveat. And I know a lot of people have been saying that the linkage between oil and the market has been broken. I told you guys I would tell you when it was broken, and I haven't reported back. So that should tell you where I think the linkage is. It's still the rumor of the death of the linkage of the market and oil is greatly exaggerated. It is still alive and well. I have been saying that 49 to 52-ish would be the kind of resistance, and that the bulls needed to hold 49 for the next $10 higher. It's been coming down. It's been coming down in a fairly choppy and controlled fashion. You're in a channel. The real key for me with regard to oil, and I'll tell you, I don't know if it's going to get this low, but you have some supports coming in roughly in the 33s, and then again, the 43s, and then the 41s. That's the 200 MA. The 200 MA is the absolute maximum that this is really kind of allowed to come down. If you get below there, I think there's going to be problems. There was a couple of caveats that I want to point out with regard to oil, and I often say that ExxonMobil is the tell for oil, and I mentioned today before the number that Exxon was weak, and I was a little worried about going into the trading, in particular in the S&P, with Exxon leading the way, that I thought oil would have a break. It wound up playing out exactly that way. I often talk about silver being the tell for the Fed. If it's leading, which way it's leading gold the day of, usually is a big tell. At least it has been for me. Exxon is the canary in the coal mine here for oil. I believe that. Hold on, we got to block someone. Block user. Real time block somebody. How awesome was that? No profanity, please. And please be respectful to people on the stream. That was pretty easy. I'm glad I was able to do that. Anyway, sorry for the distraction. Anyhow, I lost my train of thought briefly here. Let's get back to it. Exxon. So someone asked me today what my view on Exxon is. And I said that I thought that it depends on your time frame. It's into a little bit of resistance here, and you're coming into a bit of a channel high. I think Exxon is probably going to get to or close to a hundo. You have if it goes like, let's say tomorrow, the channel top is in the 95s, and then 97.25 is a big resistance point. We've had a channel low that's supported. If it were to do it tomorrow, I don't think that it will. That would be 89s, close to 89.90. That was also a big kind of support resistance level in the past. So it doesn't surprise me that if we were to get back down there, I would love to play put ratios for a move down there, meaning you buy a higher put and sell 2 times out of the money, or wait till it comes down there and then sell some out of the money puts, 85 strikes or below. I like Exxon. I just don't love buying thing. Today, believe it or not, before the reversal, it still made a new 52-week high. Still a very bullish stock, but you don't want to chase the highs. You want to buy the dips, BTD. That's what it means, right? Buy the dips. And then STR is sell or short the rips. But Exxon, to me, is still on my buy the dips list. It is the best in show. But we like the pullbacks, not the chasing. Someone asked me about natural gas. So it's hot, right? I mean, yeah, it's just hot. People are actually using their air conditionings. Go figure. It's summer and people are running their air conditionings. So it's pulling back a bit. I mean, it just is what it is, you know. This tends to vacillate in a large range. I don't really follow natural gas all that much. It's sort of like the poor man's crude oil. I kind of play. Oh, it's weird. I like to play silver, but I'm not so into playing natural gas. It had a bit of a double bottom. It's well above trend. Trend isn't even relevant at this point. I mean, it's down in like the 215s where this all kind of got started from. Yeah, I mean, you had a hammer low off the 20 yesterday. I would say that you can use that bar as a gauge. Today was sort of all over the place. We went above the high, and then today we closed the body below that body's low. You had a reversal bar. So I'll use that bounce high. If you can get now back above, 280.02, I would be more inclined to think it stays high. If you high all the time, right? If it gets below 269.7, then I think it could have a little bit more retracement. If you throw a fib on it, which is sort of one of my favorite tools, I love giving this explanation. I think it really drives home for you Wizard of Oz fans. We're a long way from Kansas, Toto. The 50% fib is $2.30.50. And the 61.8 is really where this all got started from, the 214.10. So, your kind of guess is as good as mine. The 38.2 is like 2.468. So you're kind of, at this point, just riding, riding the momentum. It looks like to me it could be due for a little bit of a pullback, but it's a pretty hot week here in New York. Last night felt like the daytime. Pretty hot out. Caveat on this whole week, I use the traffic gauge. New York City is famous for terrible traffic. Yesterday, I literally flew over the 59th Street Bridge and was whipping around like a boss in Midtown. You cannot do that with normal traffic. People are still away. Note to self, next year this time, be away. interesting market week. Just sidestep it. Take the vacay. Anyway, so that's my view. We'll use today's range with SPY, and we will we'll be good with that. Let's get into your list of some of the things you wanted to talk about. I'm just going to check them off in order. I got nat gas. What else was in here? Just want to look something up quickly. I don't really use the... there seems to be a lot of confusion with traders on how to trade VIX. So how I use the VIX is I don't like the derivatives, these like levered ETFs. Everyone always asks me about them. I would love to know if someone would tell me how often, if you added up all your wins and losses, wins and losses in these levered ETFs, where you come out. Like if you were to roll the dice 100 times, how many of them are winners, how many of them are losers? I'm guessing it's probably even or a losing proposition. That's just my take on it. I'm not a big fan of them. I like to use the VIX as a gauge for the S&P 500 and for premium as a whole. If you watched my weekend review, I pose a chart about how I use volatility premium for long or short premium. I use it in a range to judge where things are with regard to SPY. We are basically mid-range to the lower part of the range. The market tends to correct from these areas. It's possible for a pullback, although I will say this, the caveat. If we are going to have the blow-off top, meaning this like expansive move of range higher, and believe it or not, it wouldn't surprise me to see that happen since we got the big liquidation break from Brexit. We might just want to kind of tear through. I think if you can get the Fed out of the way and people have confidence in that, it can sail off into the wild blue yonder. For those of you that are curious about the impact of the Fed and fears of the Fed, check out the summer of 1929 and what happened before the crash. The summer was quite an impressive one. Someone asked me, do I think the markets are going to crash this year? I don't necessarily know that we're going to close on the high, but for the markets to crash, I think people don't really seem to understand why you get market crashes. The answer to that is liquidity and credit. What I would need to see to get, listen, you could always have a 10% or 15% pullback in the market. That does not constitute a crash. What happened in 2001 and through 2003, that I constitute as a crash, and I would constitute what happened in 2008 and 9 as a real crash. Those were, the 50-60% move times. What you need to see is I don't want to get into LIBOR spreads. It's going to be boring to tears. But if you want to take this up on your own, Google the LIBOR spreads, and when you start seeing credit default swaps blowing out, and when you start seeing, we'll keep it simple, HYG. I know the Fed is basically talking about that, what the risk premium is for risk bonds over risk-free bonds, which is what the Fed is supposed to, the Treasury is supposed to be, TLT. That's when you know things are okay. Even today with oil down badly, I said that the kind of the feather in the cap for the bulls was the HYG still closed green. That's good. What had gotten me a little bit concerned in the end of 2014 into 2015, that decline, HYG was looking like it was in full-on crash mode. That's, I believe, because there was a fear, rightly or wrongly, and I think maybe rightly, that companies in the oil and gas industry and exploration were kind of out over their skis with debt, and the oil going down to $26 was a problem for them. We're not there. We're in the 40s. Companies are fairly profitable here, and my guess, if they're smart, when oil was back up here and into the 50s, they hedged off some of their exposure to the commodity price itself. So that could be the reason. If you start seeing HYG making lower lows and lower highs, that would be a sign of credit distress. It's sort of like you need to have the blood in the water. Think about this. People who are the real weak hands in the market are the people who are out on margin. If money is plentiful and available, they don't need to pull in their margin, their markers, so to speak. I'm still curious to see if this Brexit played out with that, but it seems like it was quick enough that it's over. When you get a start of a bear market, what you usually do is get a very large break, similar to like we got with Brexit. But what happens in a bear market is it doesn't rebound quickly. That's bull market type price action. You get the big sharp break and then a rally back, and usually a rally even higher. That's more bull market like. When you get a break in a market and it just stays down and there's no rally, that's really the beginning of a bear market. So that's really what you want to start looking for. If you want to start seeing credit blowing out and you want to start seeing piss poor price action in the market, it usually starts with a big break that doesn't rebound, or the rebound is small and then it takes out those lows. So that's sort of where it comes from. If you look at Brexit, let's go back to SPY for a moment. That was just, there was really nothing there technically to other than a false breakout. That day had taken out multiple days of trade. You had 1, 2, 3, 4, 5, 6, 7, 8, 9, like 8, almost 9 days of 8 or 9 days of trade that you took out, and you squeezed a lot of shorts, and then it kind of just fell out of bed from nowhere. If you didn't have the Brexit, you'd probably think that that day was a bit of a breakout. I mean, I've seen this happen with earnings very often, where there's that kind of false dawn and then it kind of comes down. I think that's really just what happened here. Let's just go by the levels. Why even guess? I never like to play that guessing game. I go where the levels take me. I find that a lot of people come up with these very dogmatic ideas like the market has to crash or the market has to rally, and they ignore, they let their opinions bias by their trade. I actually blocked someone on Twitter the other day who accused me of being misleading. I mentioned the other day that the market came down, it was on the 50 MA. I don't even know if I gave my bias. My bias was, the person said rightly that I was looking for a bounce, and it wound up being the low of the day. And then today you had this, then the next day you had this false breakdown and rallied huge. So this guy was telling me, it's a guaranteed 30 points lower, and that I'm misleading people. I don't know what the hell he's talking about. And obviously he was wrong. So I have I don't know, it just seems like I have a lot of people who like to contradict me on the stream sometimes, and they like to try to earn brownie points. Whatever. I mean, they're usually wrong, so it is what it is. But the point being there was that he had a preset condition and wasn't just going by the levels. I always go by the levels. And for me, today you held the levels you needed to hold, so I have to be a little bit more optimistic than not. If we were to start losing today's low and start losing, what was that, Tuesday? Yeah, Tuesday's low and the 50 MA, then I'll start getting a little bit more bearish short term. Some people had asked me, I had posed a thesis about if we're forming a larger head and shoulders here. The pattern now is super sloppy because of Brexit, but if you kind of X out the some of that slop, the pattern could still be playing out. It'll take time. It's going to take time. You need to really build out that shoulder. It's not going to happen like, one day you're down huge. I mean, unless there's news. It would need to kind of build out and then have a liquidation break that continued. The market would need to kind of build inventory up here, get people, overly long, and then, have the rug pull. If we are, though, however, to get over the Brexit high, if we were to clear the 210 to, the 211 finally, then I would say that that's likely off the table. As long as, I guess, we're below the 210.92, 211, you could make that case. Above there, it is completely negated, and you kind of have to just throw in your towel. With my observation about people that are bearish, they are the same people who were bearish pre-failed head and shoulders, during the head and shoulders, and then after it was negated. So it's just the same people again and again. There hasn't been much capitulation there. Anyway, that's SPY. Facebook, so that wound up being a really opportunistic play. I talked about buying that on the trend and the gap fill. It stopped like to the tick, and then yesterday I said you want to start trimming into the 116s. Today's bar closed below the 50, although yesterday closed above. You didn't take out half or more of yesterday's bar. I think that as long as it kind of can hold the 20 MA here, the path of least resistance would be higher. Anything below that to me, or anything below yesterday's breakout bar, you could use yesterday's range as your gauge. Above that range is bullish. Inside, you can just kind of hang out and drink stout. Anything below the 112.97, that would be the double bottom, is a short, at least for right or right out. So the ideal scenario, believe it or not, for Facebook would be to spend like 2-3 days going sideways and then going. At least consolidate some of this range. The 116s were a big level support. They should now be a little bit resistance. If they don't resist, I mean, if we can get through again, then I think it can go higher. So longer term, I mean, that was just the trade, kind of buying the gap fill and then taking some profits into the resistance. Played out really well. I still have a little bit of Facebook long, but a little less long after yesterday. Apple is just kind of chopping around here. I'm thinking, this is my thought on Apple. If they rally it hard into the earnings, you're probably going to get one last rug pull, and then people will probably buy it for the iPhone 7. If this was to be weak ahead of time, then I think it could set up for a long. It might be a bit of a Costanza play. We're just chopping sideways here. There's really no edge on it. I had said that once I saw it holding the 92 area and putting in that kind of secure low, I thought we'd fill the gap. It did. It's just kind of chopping around below there. There's another gap to fill higher. I think this is back up to the what would have been close to the 61.8. The full gap fill is 204.35. The 61.8 is 103.60. I think it fills at some point, but I don't know the kind of the trajectory. You know, if we have to go lower before higher, or if they want to fill it and then dump it. My favorite play with Apple is the shake and bake, where it gets smacked ahead of time and then it's a buy. So I'm going to kind of probably be in the Costanza camp for this one. Do the opposite. With regard to Apple IV, if you want to play it with buying or selling premium, you want to be more of a premium buyer now. The IV is super cheap. The normal IV for Apple is 25.26. The current IV percentile is 11. You don't want to really be selling premium. You want to wait for that to spike up into the 30s or 40s on an absolute basis, and then that would be the area to kind of start selling some premium. Someone asked me about TLT. If anyone wants to know why the market is staying stubbornly strong, it is because of TLT. I heard a debate on TV the other day with two very smart gentlemen. I think it was on on Fast Money, and they were talking about should the market be trading at a premium or a discount based on TLT. So when TLT gets high, when bond yields get super low, people start thinking recession. And we all know earnings have not been super duper strong, particularly earnings growth. So under that scenario, yes, you would be trading at a PE multiple discount. The extra piece that many people fail to include is where absolute interest rates are. We can't even get above 2%. When markets peak, someone asked me, is the market going to have a crash? 1929, 2000, 2007, interest rates peaked at 6%. That is the magic number that causes problems. Why? Because when you think about stocks, when you want to get a dividend yield, you're usually looking for something about 5%. Above 5% is fantastic, and you don't need the price risk exposure from stocks. So people sell their stocks and they buy bonds. As interest rates come up, the weighted average cost of capital, which is the discount factor which is the hurdle rate, the discount factor in DCF analysis, which is discounted cash flows, which is the model in which stocks are priced. I don't want to get too wonky on you guys here, but think about it as a division problem. This is the easiest way to think about it. You have a top number and a bottom number. If the bottom number is larger, the end product is smaller. If the bottom number is smaller, the end product is larger. The weighted average cost of capital is a very large piece of the lower number, the denominator. So that is the PE multiple premium. As the interest rates go higher, the end product becomes less. As interest rates go lower, the end product becomes more. So that is the PE multiple premium. As interest rates are low, stock prices should be high and command a premium. Yes, yes, yes. We all know when interest rates go up, and they will eventually, you will have hell to pay. It's a good game of musical chairs. Let's give you an example. Johnson & Johnson is trading at 22 times earnings. They don't have a lot of growth. Google, which is one of the greatest growth stories in the history of the world, is trading at 29 times earnings. Not very much more than J&J, and if you use forward multiples, it's probably trading at an even lower PE multiple than Johnson & Johnson. So Google, innovators who are changing the world, or Johnson & Johnson, who makes Band-Aids. Stable business, great dividend, and bond equivalent. When you have problems, what is sort of the leading into the problem, it doesn't mean the problem is upon you, but it's always this way. Bond managers need yield, and they chase it anywhere they can find it. When they run into trouble is when they get cute and go overseas and buy things like Spanish bonds because they're yielding, let's say, 7% and the Treasury here is yielding 3%. Sounds great until the ish hits the fan and those bonds get destroyed. That is when you get credit crises. That isn't really what's going on right now. Yields around the world are rather low. Germany, you have to pay them to take your money. Pretty crazy. Why are yields so low in Germany? The banks don't have FDIC insurance. People are putting their money into the bonds as basically safe deposit boxes. When things get scary, they worry about a return of their capital, not a return on their capital. And as long as yields over there are cheap, the U.S. yields seem high, very cheap. How about CDS yields spiking in European banks? Yeah, there's issues over there. My problem with the European banks is this. I don't know that they have a credit crisis on their hands over there, although a lot of people think they do. I don't know whether they do or they don't. My guess, though, is that if you look at our banks, they're trading at very low PE multiples because we have, I guess, ZERP or whatever is the program, low interest rates, zero interest rates. They're basically very low. In Europe, it's even worse. They have NERP, which is the negative interest rates. So as hard as it is for our banks to make money, the Europeans are having it even harder. So that is why I think these banks are getting smacked around. And then there's also the fear of who has what and what the currency exposure is. You know, European currencies are whipping around like biotech stocks. It's striking. That also feeds into my theory of why the Fed would want to be on hold. But yes, these European stocks, the banks, are not trading with a lot of confidence, and there could be some issues over there. We're going to have to see how that plays out. That could lead to a bit of a crisis. My feeling at the moment is that it's just that their earnings models are impaired, but you never know. I would kind of, if you have the stomach for it and you can hold on to that stuff for like 5 or 10 years, you might want to nibble away at a few. They can't all go to zero, and the ones that succeed will do really well. But, there's other easier places to play in the market. Truth be told, I've been slowly nibbling on a few of them. Don't want to get too into that, though, but slowly nibbling. Based on that thesis that they all can't be zeros. Someone asked me about Lululemon. Changing gears, right? European box to yoga pants. I guess kind of the same thing, right? Anyway, I've been a bull on Lululemon for a while. It's ripping. It broke the downtrend quite some time ago. I do think that there is a likelihood it's going to retest the old all-time high. I like buying the dips. I don't love to chase when things are making brand new highs. If you're long, I would hold on to it. If you want to be long, as long as the stock is making higher lows and higher highs, it's a buy the dip stock. Any stock, in my view, that makes higher lows and higher highs is always a buy the dip stock. And when a stock is making lower highs and lower lows, it is a short the rip stock. Very, very simple. Oil. I think I covered oil. I covered the VIX. Gold. GDX. These minor. I was bullish on the miners near the lows. I clearly sold a little too early. I haven't been in the miners for a while, although I thought I had caught quite a rally. But wow, it's even more impressive. This is really wow. I think this is looking very short-term overdone. It can get more overdone. It could go higher, but I can't say that something moved from 1240 to 3068, and now is the time to pile in right here without any pullback. 50 MA to me would be a good area for row, right or right out, or a trend touch at least. Yeah, I mean, it could go higher, fully aware of that, but it will do it without me at this point. At some point, you got to have your own discipline, and buying something that has been moving in a bit of a parabolic fashion is a little bit scary. I also think that the fact that everyone is very excited about them has me thinking that I'd rather be kind of selling a little bit when I can, not when I have to. I was long silver for quite some time. I booked some profits. It turned out to be a little bit early on that one too. I guess I'm a bit of a Baron Rothschild philosophy. They asked him how he made so much money on the bourses. He said, "I never buy the bottom, and I always sell too soon." It's painful sometimes to miss the last couple of percent, but when something is down 30% after you've sold and you miss the last 2 or 3%, you don't really care. I often find myself in that position. Anyway, silver is a beast. I think it's going higher, but I would, at this point, need to buy it on a dip. It's above the channel. For me at this point, I booked some profits. I am going to be looking to reload on a bit of a pullback. XLU, that's got to be the top, right? When someone is asking me about utilities, not a very exciting sector, although I guess it is, right? They're trading quite bullishly. Just pulling up a longer-term chart here. Weekly. Yeah, so this has been in a really big channel for a while. It's getting near the upper end of it. It's very overbought stochastically. It's got a little bit more room to the upper part of the channel. Yeah, bullish. I mean, this thing could really just completely blow off. Let's see, what is this thing yielding at this point? XLU. The PE multiple on this, I don't know if this is right or wrong, but it's 34.9, a regular bargain for utilities. And it's yielding 3%, so that's why it's rallying. I would say it's a BTD, but I would wait for the D, That's my view. In the end, this could be years from now. Who knows? This will eventually come down quite a bit, but as of now, it is in an uptrend within an up channel, and it is getting a little bit near the upper end of the channel, so I'd probably be a seller on pops here, and then a buyer on the channel. Simple. Actually, let me post. This is a weekly chart. I'm going to post it right now on the Twitter, right, as they say. So XLU chart with channel and trend. All right, that's going to be tweeted out live. If you're not following me, my handle is @JustinPulitzer on Twitter. So that's XLU. Someone asked me about First Solar. Rightly or wrongly, this is going to trade with oil. It, to me, today looks like a bit of a trend break. Yeah. Yesterday was a look below and fail, and then today is just a plain fail. You have some supports coming in around 39 to 40s, but you know, a snap here could fill up the triangle quite a bit. When do they have earnings? They report soon too on 8/2. This came down. You see, this thing came down from the top, so you're in the. I think you'll find a little bit of horizontal support here. The worst thing that this could do is just chop sideways for a few days and then snap. If you get that, like it goes sideways for a while, I would try right out short with a stop above the range, and then play for the break lower. But this has moved a lot now already. The high here was 74, and now you're trading in the 40s. Not all trend line breaks are created equally. I would think that this is going to hold in that area and bounce a bit. I would be looking though to probably I don't know. I'm a little bearish on this. But it is just in a sideways range. I wouldn't initiate short here, and like I said, unless it spent some time going sideways. This is also on a weekly chart. Let me look at the daily. I was going to say this is looking a little funky. Yeah, this is today's move is pretty horrendous. You had the prior 2 days had double bottoms, and then it was sort of like a failed breakout of range. Yeah, this doesn't look pretty to me. I'm not a big fan of this right here. Twitter. So Twitter has been showing a lot of, I guess, relative strength lately, right? We're filling a gap. I hate that it's rallying right ahead of earnings. The story with Twitter is that they're moving really slow. They're not doing a great job monetizing. It's not really an expensive stock like it used to be anymore. It was kind of expensive in the 40s and stuff. Twitter now isn't really all that expensive. They do have some cash on the balance sheet. Yeah, I mean, I guess you could play buy the dips with this. I mean, I think eventually someone's either going to buy them or they'll right the ship. I don't think this thing is going to be a zero. If we get into a bear market, this thing could be a single-digit stock, though. Keep that in mind. But let's just play it with the trend, you know? I mean, as long as you're... I happen to have a little Twitter long. I don't really look at it day to day. It's just sort of like a longer-term play that maybe eventually these guys will get their act together. It looks like it's trying to form a bit of a rounded bottom. Slightly overbought in the stochastics here. I mean, I wouldn't be chasing it into the gap fill, but, you know, if you want to buy the dips, that to me makes a lot of sense. So I hope I kicked some knowledge out to you guys. I got to get going. I have an appointment I have to get into. Someone asked me, which website do I use to look at the multiples? You can just look at it on TOS or any trading platform. They have the current PE multiple. For forward PE, you could just use Yahoo Finance. That's always a good one. I mean, I've been using Yahoo Finance since the 90s. It's always been okay. I like, there's also another website I like, a couple of little, if you're away, like you don't have your trading platform in front of you, I like this website, finviz.com. I think that they're pretty good. And then I like this website, shortsqueeze.com. It gives the short interest. Those are sort of the ones I use on the fly. Anyhow, that's my story. I'm sticking to it. If you happen to catch this broadcast late or want to watch it again, I'm going to post it on my YouTube channel. It's Justin Pulitzer Trades. I'll try and get that done now, actually, before I head out. If not, it'll be up tonight. Yeah, that's the story. There'll be a rebroadcast. I post weekend review videos, which are kind of the big show. This is sort of my clarification channel for that, and also to answer more qualitative instead of quantitative. That's the more quantitative with technical analysis. And I often post special edition videos there. I've been a little remiss with doing new ones, but the ones that are on there are really good. I think so, anyway. Anyway, yeah, I like that. Thanks, and cheers. We'll see how that employment number goes. Again, SPY range above today's high of day. I think we get a squeeze higher. Below the low of day, I think we get a today's low. I think we can get a bit of a move lower. All right, cheers. Oh, and if we pin 210 tomorrow, do some shots. We did one last week. We'll do two this week. A double. Done. Cheers.